Have you ever wondered why two traders can look at the same chart, place the same trade, and end up with completely different results? It's not luck. It's not just strategy. It's mindset. Most people think trading is about finding the perfect indicator, the secret pattern, or the magic strategy. But here's the truth. The pros aren't playing the same mental game as everyone else. Their edge comes from how they think, how they react, and how they see the market when others panic. This video's not about fancy indicators or complicated systems. It's about the 12 rare mindsets that separate amateurs from professionals, the hidden ways of thinking that allow top traders to stay calm when others lose control, to survive when others blow up, and to win when others quit. If you've ever felt stuck, emotional, or frustrated in your trading journey, this video will give you a fresh lens. It will teach you how pros think, and once you learn to think like them, your entire trading game will change. Because the real secret of trading isn't on a chart, it's in your mind. Chapter 1. Think in probabilities, not certainties. Have you ever taken a trade, felt 100% confident it was going to work out, only to watch the market move against you almost instantly? You probably told yourself, this was the perfect setup. How did I lose? That's the moment where most traders get trapped. They think trading is about being right on every trade, when in reality, professional traders know the truth. Trading is not about certainty. It's about probabilities. This mindset is the single biggest shift between an amateur and a professional trader. Amateurs chase perfection. They look for the one strategy, the one indicator, the one holy grail system that will give them guaranteed wins. Professionals know no such system exists. Instead, they treat trading like a probability game, much like a casino or a professional poker player. They know they can lose individual hands, but as long as they keep playing the game with discipline, the odds will eventually work in their favor. The trap of certainty. Most new traders come into the market with the wrong expectations. They believe if they study hard enough, backtest long enough, or follow the right guru, they can find certainty. They want a strategy that wins 90% of the time. They want to eliminate losses altogether. But losses are not mistakes. Losses are part of the game. Think about a casino for a moment. When you walk into a casino in Las Vegas, the casino doesn't know whether you're going to win or lose the next hand of blackjack. They don't know whether the next spin of the roulette wheel will land on red or black. What they do know is that over hundreds of thousands of spins, the math works in their favor. They are not playing for the next hand. They are playing for the next 10,000 hands. That's why casinos make billions every year, while gamblers keep losing money. Most traders play the market like gamblers. They bet everything on the next trade. They obsess over being right this time. Professionals play like the casino. They understand each trade is just one outcome in a much larger series. Winning or losing on a single trade doesn't matter as long as the odds of their system play out over time. The probability mindset. To think in probabilities, you must detach your identity from each trade. A trade is not a reflection of your intelligence, your skill, or your worth as a trader. It's just one outcome. Professionals know that their strategy has both winners and losers. They accept losses as the cost of doing business. Imagine flipping a coin. If you flip a coin 10 times, you might get 6 heads and 4 tails, or even 8 heads and 2 tails. That's randomness in the short run. But if you flip that coin 1,000 times, you'll see the results hover very close to 50-50. That's probability in action. Trading works the same way. A trading strategy might have a 55% win rate. That means over 100 trades, you should expect to win 55 and lose 45. But here's the kicker. You don't know which trades will be the winners and which will be the losers. They come in random distribution. You might lose 5 trades in a row, then win 7 in a row. You might have 10 winners, then 10 losers. If you obsess over being right each time, you'll give up after a losing streak. If you think in probabilities, you'll keep playing, because you know the long-term math is in your favor. Detaching from the need to be right. One of the most dangerous mindsets a trader can have is the need to be right. Humans naturally hate being wrong. We're wired to protect our egos. In trading, this shows up as holding on to losing trades far too long because we don't want to admit we were wrong. Or it shows up as revenge trading, trying to win back money we just lost so we can feel right again. Professionals don't think like that. They don't need to be right. They need to make money. Those two are not the same thing. You can be wrong more than half the time and still make a fortune if you manage risk and let winners run. Imagine a system where you win only 40% of the time, but your average winner is 3 times bigger than your average loser. Over 100 trades, you might lose 60 trades and win 40 trades. But if your average loser is $100 and your average winner is $300, then you'd lose $6,000 and win $12,000. That's a $6,000 profit, despite being wrong 60% of the time. The amateur thinks, I can't trade with only a 40% win rate. The pro thinks, I don't care about my win rate as long as my probability of long-term profit is high. Embracing randomness. One of the hardest things for traders to accept is randomness. We love patterns. We love certainty. But the market doesn't owe us either. The truth is, no matter how good your analysis is, you can't predict the next trade with certainty. You can only prepare for probabilities. This is where risk management becomes critical. Professionals don't bet the farm on any one trade because they know they could be wrong. Instead, they size their trades so that even a losing streak won't take them out of the game. Amateurs blow up accounts because they put too much money into one trade, believing it's a sure thing. Pros never fall for that trap. Think back to the coin flip example. If you bet your entire net worth on one flip, you're playing a game of certainty. You either win everything or lose everything. But if you bet 1% of your net worth on each flip, you can survive thousands of flips. That's how pros think about trading. It's about survival first, profit second. Probability thinking in action. Let's bring this to life with an example. Imagine you're trading a strategy that has a 50% win rate, but your winners are twice as big as your losers. Over time, this strategy has positive expectancy. It should make money if you stick to it. Now let's say you take your first trade and it loses. The amateur thinks, this strategy doesn't work. I need a new one. The pro thinks, this was just one outcome in a series of hundreds. My edge hasn't played out yet. You take the second trade, and it loses again. The amateur is frustrated, angry, maybe even ready to quit. The pro is calm. They know 2 losses in a row mean nothing in the grand scheme of probabilities. They stay disciplined. Then the third trade wins, and the fourth, and the fifth. Suddenly, the math starts working. By trade 50, the pro is in profit, while the amateur has already given up. That's the difference probability thinking makes. The casino mentality. To drive this point home, think about how casinos operate. They don't care if you walk away from the blackjack table with a win. They don't care if the roulette wheel lands on black 10 times in a row. They know that over thousands of hands and spins, the house edge guarantees them a profit. That's why casinos are billion-dollar businesses. The market is the same. If you treat trading like gambling, the market will take your money. If you treat trading like a casino, by managing risk, playing probabilities, and thinking long-term, you become the house. And in the end, the house always wins. How this mindset changes your trading. When you start thinking in probabilities, everything changes. Suddenly, Losses don't hurt as much because you know they're part of the game. Wins don't inflate your ego because you know they're just another outcome. You stop chasing certainty and start focusing on consistency. This mindset frees you from emotional trading. It allows you to stay calm during drawdowns, to stick with your strategy through rough patches, and to avoid blowing up your account. More importantly, it puts you on the path of professional thinking, the kind of thinking that separates long-term winners from short-term dreamers. A trader's new identity. From this point forward, I want you to stop thinking of yourself as someone who needs to be right in the market. Instead, see yourself as someone who plays probabilities. You are no longer a gambler hoping for the next big win. You are the casino, patiently letting the math work in your favor. When you make this shift, your entire trading journey will transform. You'll stop chasing the Holy Grail system. You'll stop panicking after a loss. You'll stop feeling like trading is unpredictable chaos. Instead, you'll see the market for what it is, a probability machine. And once you learn to think in probabilities, you'll never look at trading or at life the same way again. Chapter 2. Embrace boredom, not excitement. When you think of trading, what image comes to mind? For most people, it's flashing charts, adrenaline-fueled decisions, traders shouting on Wall Street floors, and big money being made in seconds. Hollywood loves to paint trading as a high-octane, thrilling, get-rich-quick adventure. But here's the reality. The traders who actually last in this business, the ones who make consistent money, will tell you their day-to-day life is anything but thrilling. In fact, they'll often use the word boring. That's not because they lack passion or drive. It's because they understand something that most beginners don't. Real trading success comes from consistency, not excitement. The market rewards discipline, patience, and repetition, not emotional highs and lows. If you want excitement, head to a casino or buy a lottery ticket. If you want to build wealth in the markets, you must learn to embrace boredom. Why? Excitement is dangerous. Excitement feels good. It gives us a rush. When you take a trade and the chart explodes in your favor, dopamine floods your brain. It's the same chemical that gamblers feel when the roulette wheel spins. That rush makes you crave the feeling again, and soon you're chasing excitement instead of profits. The problem is that excitement often comes with impulsive decisions. You start overtrading because you want more action. You abandon your rules because you feel something big is about to happen. You put too much money into a single trade because you're chasing the thrill of a big win. And in the end, the market humbles you. Professional traders don't chase excitement. They've trained themselves to see trading as a process, not an emotional roller coaster. They know the rush of excitement is dangerous because it clouds judgment. To them, the calmness of routine is more valuable than the high of adrenaline. The paradox of trading. Here's the paradox. The more boring your trading feels, the more profitable it often becomes. When your days look the same, reviewing setups, following your rules, managing risk, executing with discipline, you remove chaos from your trading. And the less chaos you have, the more consistent your results become. Beginners hate boredom. They want to do something all the time. They can't stand sitting on their hands waiting for the right setup. They feel like they're missing out if they're not in a trade. But pros understand that doing nothing is often the best move. They know that patience is part of the edge. Think of a sniper in the military. He doesn't fire at every movement he sees. He can sit in the same spot for hours or even days, waiting for the perfect shot. To an outsider, it looks boring. But when he finally pulls the trigger, it's decisive and effective. Trading is the same. Your edge doesn't come from firing bullets all day. It comes from waiting, preparing, and then acting with precision when the opportunity is right. The myth of constant action part of the problem comes from social media. Scroll through YouTube or TikTok, and you'll see traders posting highlight reels of their crazy trades. They show screenshots of massive gains in a few minutes, charts exploding up and down, and fast-paced action that looks exciting. What you don't see is the losses, the waiting, the discipline, and the boring parts of their process. This creates a false expectation. New traders think they should be trading constantly, making big moves every day, living in a permanent adrenaline rush. But the reality is much quieter. Professional traders might only take a handful of high-quality trades in a week. Sometimes they sit on the sidelines for days because nothing matches their criteria. And while that sounds boring, it's exactly why they survive and thrive. The myth of constant action destroys more traders than anything else. If you can learn to enjoy the quiet periods, you're already one step ahead of most people in this game. Turning boredom into power. So how do you actually embrace boredom? The key is to reframe how you see it. Boredom isn't a lack of opportunity. It's a sign of discipline. When you're bored, it means you're not forcing trades. You're waiting for your edge to appear, and in trading, waiting is a superpower. Think about a farmer. He doesn't dig up his seeds every day to see if they're growing. He plants them, waters them, and waits for the season. That waiting period might feel boring, but it's essential for the harvest. Trading works the same way. You plant your trades by following your strategy, you manage them with care, and then you wait. The waiting isn't wasted time, it's part of the process. The role of routine boredom often comes from routine, and that's a good thing. Professionals thrive on routines. They wake up, review the market, check their setups, and follow the same checklist every day. At first, it may feel repetitive, but over time, it builds consistency. Routine reduces emotional decision-making. When you have a set process, you're less likely to chase random trades. You don't need to rely on hunches or gut feelings. You simply follow the steps you've already committed to. And while that might sound boring, it's the very thing that keeps you consistent. Amateurs crave excitement because they lack a routine. They sit at the screen with no plan, waiting for something to happen. Professionals create their own structure. They don't let the market control them. They control their process. Discipline. Over drama, here's something most people don't understand. Trading is not supposed to be dramatic. If your trading feels like a soap opera, filled with wild emotions, constant anxiety, and dramatic highs and lows, you're doing it wrong. Discipline kills drama. When you're disciplined, you don't get too excited about a win or too devastated about a loss. You see both as part of the process. You take the trade, log the result, and move on. That kind of emotional balance might not make for an exciting story, but it makes for a very profitable trader. The best traders often say, trading should be boring. Your life should be exciting. In other words, don't look for thrills in the market. Find fulfillment outside of trading. In hobbies, relationships, and adventures, let your trading be the calm foundation that funds those experiences. Real-world example. The turtle traders. One of the most famous trading experiments in history proves this point. In the 1980s, Richard Dennis and William Eckhart recruited a group of everyday people and trained them to trade using a simple set of rules. They became known as the turtle traders. The turtles weren't taught to predict the market or chase excitement. They were given a system and told to follow it with discipline, no matter how boring it felt. Some of them became millionaires because they embraced the routine. Others failed because they broke the rules, chasing action and excitement. The lesson is clear. Following boring rules with consistency beats chasing thrilling trades every single time. Managing the urge for excitement. Let's be honest, boredom isn't easy. Humans are wired to seek stimulation. When you're sitting in front of a screen for hours and nothing is happening, your brain screams, "Do something." That's the moment where most traders make mistakes. To fight this urge, you need strategies. One approach is to limit your screen time. If your system doesn't require constant watching, step away from the computer. Go for a walk, read a book, work on a skill. The less time you spend staring at random price movements, the less tempted you'll be to take impulsive trades. Another approach is to track your trades in a journal. When you write down every decision, you become more aware of your patterns. You'll notice how often your boredom trades end in losses. Over time, the evidence will convince you that boredom is safer than excitement. Long-term fulfillment versus short-term thrills. It's important to understand the difference between thrill and fulfillment. Excitement gives you a short-term rush, but it rarely lasts. Fulfillment comes from long-term achievement, consistency, and mastery. Trading for excitement will eventually burn you out. Trading for consistency will build you a career. The boring path is the one that leads to long-term fulfillment. It might not feel exciting in the moment, but when you look back after years of consistent success, you'll realize it was worth it. Boredom as a sign of mastery. Have you ever noticed that experts in any field make their work look easy? A professional chef can cook a complex dish with calm precision. A pro athlete can execute a move without breaking a sweat. That calmness comes from repetition. It comes from doing the boring work over and over until it becomes second nature. Trading is the same. When your trading feels boring, it's a sign you've reached a level of mastery. You're no longer driven by chaos or desperation. You're calmly executing your edge. That's not a weakness, it's a strength. Final thoughts. The beauty of boredom. At first, you might resist this idea. You might think, I didn't get into trading to be bored. But if you can shift your mindset, you'll see boredom in a new light. Boredom means you're following your rules. Boredom means you're not chasing impulsive trades. Boredom means you're building consistency. And in the end, consistency is what creates wealth. When you learn to embrace boredom, you're not just becoming a better trader. You're becoming a more disciplined person. You're learning patience, self-control, and the ability to stay calm under pressure. These skills extend far beyond trading. They'll help you in business, in relationships, and in life. So the next time you find yourself staring at the screen, feeling restless, remind yourself, boredom is not your enemy. It's your greatest ally. Embrace it, and you'll unlock the mindset of the pros. Chapter 3. Cut losers fast. Let winners run. One of the hardest lessons traders must learn is this. Small losses are the cost of survival, and big wins are the fuel of growth. Yet most traders do the exact opposite. They cling to losing trades, hoping they'll turn around, and they sell winning trades too early out of fear of losing profits. This pattern destroys accounts faster than any bad strategy ever could. It's not the market that beats most traders. It's this psychological trap. Professionals know that the key to long-term success lies in flipping this script, cutting losers quickly, without hesitation, and letting winners ride further than your emotions want to allow. It sounds simple, but it's one of the most difficult shifts a trader can make. Why traders struggle to take small losses. Let's start with losses. Nobody likes losing. Our brains are hardwired with something called loss aversion bias. Psychologists have shown that losing $100 feels about twice as painful as the joy of winning $100. In other words, the pain of loss is stronger than the pleasure of gain. This is why traders freeze when a trade goes against them. They don't want to admit defeat. They tell themselves, it'll come back. Just a little more time. I'll break even. And sometimes, by sheer luck, the trade does bounce back. But often, it doesn't. What started as a small loss grows into a big loss, then into a disaster. Think about it like a small fire in your kitchen. If you put it out right away, it's manageable. If you ignore it, hoping it burns itself out, it can spread and burn down your whole house. Small losses are like those small fires. Deal with them quickly, and they're no problem. Ignore them, and they'll destroy your account. Professional traders understand this. They have hard stop losses in place. They don't argue with the market. When the trade proves them wrong, they exit without hesitation. It's not weakness, it's discipline. Why traders kill their winners? Too early. On the flip side, most traders cut their winners too soon. Imagine you enter a trade, and it starts working. Your heart races as you see profits build up. But instead of letting the trade run, you close it quickly. Why? Because you're afraid it will reverse, and you'll lose the unrealized profit. This comes from a scarcity mindset. You think, I don't want to let this gain slip away. I better lock it in. But by doing this, you sabotage the trade's potential. You take $100 of profit when the trade could have given you $500 or $1,000. Professionals do the opposite. They trust their systems and let the winners run. They understand that the big wins pay for many small losses. They're willing to watch a winning trade fluctuate because they know the real edge comes from the long move, not the quick exit. It's like planting a fruit tree. If you chop it down after it grows just one apple, you'll never see the orchard. It could have become the asymmetry of trading. Here's the beauty of cutting losers and letting winners run. It creates asymmetry. Your downside is small, but your upside is big. That's the formula for exponential growth. Let's put numbers on it. Say you risk $100 on each trade. You cut your losers quickly, so every losing trade costs you $100. But when you win, you let the trade run and make $300. Even if you only win 40% of the time, the math works like this. Out of 10 trades, you lose $600. You win 4 trades, each giving $300. Won $200. Net profit is $600. You're wrong more than half the time, yet you're profitable. That's the power of asymmetry. Most beginners don't get this. They flip the formula. They let losers grow to $300 and cut winners at $100. Even with a high win rate, they lose money long term. Professional traders live by this principle. Small losses, big wins. The ego problem. A big reason traders fail to cut losers is ego. Nobody likes being wrong. When a trade goes against us, we feel like it's a reflection of our intelligence or our ability. So instead of admitting we were wrong, we hold on to the trade, hoping it will turn around and save our pride. But trading isn't about being right. It's about making money. Professionals have no problem being wrong because they know being wrong is part of the business. In fact, they expect to be wrong often. Think about Jeff Bezos, founder of Amazon. He once said, "Our success at Amazon is a function of how many experiments we do per year, per month, per week, per day." Many of those experiments failed, but the ones that worked paid off massively. Trading works the same way. You don't need to be right every time. You just need to cut the wrong ones fast and let the right ones grow. The fear of missing out. Another trap that keeps traders from letting winners run is fear of giving back profits. Imagine you're up $500 in a trade, then it pulls back, and now you're only up $300. You feel like you've lost $200, even though you're still winning overall. This tricks traders into closing trades too early. Professionals think differently. They understand that fluctuations are normal. A stock, a currency, or a crypto asset rarely moves in a straight line. There will be pullbacks along the way. If your analysis is solid, you ride the waves instead of jumping ship at the first dip. Think of surfing. If you bail at the first wobble, you'll never ride the wave to the shore. Pros stay on the board, even through small bumps, because they know the big ride is worth it. Systems that enforce the rule one of the best ways to master this mindset is to build systems that enforce it. Many professional traders use mechanical rules like stop losses and trailing stops. A stop loss ensures your losers never grow too large. A trailing stop allows you to capture more profit while still giving the trade room to breathe. By relying on systems instead of emotions, you protect yourself from your own psychology. This is why many traders automate parts of their process. They know human emotions can't always be trusted. Even if you trade manually, you can write down your rules and commit to them. For example, I will risk no more than 1% of my account. On any trade, I will let winners reach at least 2x risk before closing. Over time, these rules build discipline and consistency. Historical proof. The greats do it. Some of the greatest traders in history lived by this principle. Jesse Livermore, one of the most legendary traders of the early 20th century, famously said, "The big money is not in the buying or the selling, but in the waiting." He understood that holding on to winning trades was the key to massive profits. Another example is Paul Tudor Jones, one of the most successful hedge fund managers of all time. He kept a note on his desk that said, "Losers average losers." In other words, never add to losing positions, cut them fast. That mindset helped him build a billion-dollar fortune. These legends weren't superhuman. They just mastered the ability to control their losses and maximize their gains. The psychology of cutting losers. When you cut a loser quickly, it might feel painful in the moment, but it builds psychological strength over time. Each time you honor your stop loss, you prove to yourself that you have discipline. You show yourself that your ego doesn't control you. That confidence compounds. On the other hand, when you let losers grow, you teach yourself the opposite lesson. You tell your brain it's okay to break rules. Soon, your discipline erodes, and your trading becomes emotional gambling. That's the road to ruin. Every small loss you take is like a gym. Rep for your trading psychology. It makes you stronger, more resilient, and more professional. The psychology of letting winners run. Letting winners run requires a different kind of strength, patience. It's not easy to sit on a trade while it swings up and down. Your brain screams at you to take the money and run. But when you resist that urge, you train yourself to trust your system. Patience pays. Sometimes, the difference between a mediocre month and a great month is just a few big winners that you held longer. Those trades don't come often. But when they do, they make all the difference. Think of a fisherman casting lines into the water. Many casts will bring up nothing, some will bring small fish, and once in a while, he'll catch a big one. If he throws back the big one too soon, he'll never feed his family. Letting winners run is like holding on to the big catch. Building a winner's mindset. The truth is, cutting losers fast and letting winners run isn't just a trading tactic. It's a mindset. It's about humility and courage. Humility to admit when you're wrong and exit quickly. Courage to stay in the trade when you're right and let profits grow. Most people lack one of these qualities. They hold on to losers out of pride, or they sell winners out of fear. To succeed, you must develop both qualities together. This mindset extends beyond trading. In life, too many people hold on to bad jobs, toxic relationships, or failing ventures because they don't want to admit defeat. At the same time, they abandon promising opportunities too early because they fear the risks. Learning to cut losers and let winners run can transform not just your trading, but your entire life. Final thoughts. If you remember nothing else from this chapter, remember this. Losing small and winning big is the holy grail of trading psychology. It flips the game in your favor. Every time you cut a small loser, you protect your capital and live to fight another day. Every time you let a winner run, you multiply your edge and build exponential growth. This is the formula professionals live by. And it's the formula that separates consistent winners from the masses who blow up accounts.